Welcome to Sir Fritz Social Studies class, Economics. And in this video, we will discuss monetary policy. To understand monetary policy, let us first define what is a money. Money refers to any tradable object or instrument that may come in the form of paper, coin, bonds, credit, and many more. It is any form of object that may be used as a means of exchange, standard value, and store value. From a global perspective, every country has its own form of money or currency, and through the use of money, goods and services are exchanged within the territory. Governments around the world manage the flow of exchanges of goods and services. Money aids the government in evaluating the value of goods and services being exchanged in its territory. Politically, the government uses fiscal policies in handling the resources of the country. However, for the government to responsibly handle the resources of a country, it needs the assistance of a central bank. In the Philippines, we have a central bank, which we call the Bangko Sentral ng Pilipinas or BSP. The Central Bank of the Philippines or BSP aims to keep the economy of the country strong and stable. It is also the one that establishes and safeguards the credibility and value of the peso. The BSP gives the general direction on how to use the money since it is considered the bank of all banks. It oversees all banking operations and non-bank financial institutions. Here are the other responsibilities of BSP. It oversees the buy and sell of assets. It creates money. It lends to banks when short in cash. It handles government bank accounts. It safeguards reserve foreign currencies. And it monitors and sets the foreign exchange. The banks are the link between deposits and investments. And for the Bangko Sentral ng Pilipinas to effectively manage the financial system of the Philippines, it needs the help of our domestic banks. Here are the different types of banks we have in the country. We have the commercial bank, the biggest and broadest bank that accepts any kind of deposits from the public, offers loans as starting fund for businessmen, household loan like auto, housing, and discount rates for promissory notes, bills of exchange, and any certificate of loans, letter of credit, and other services. Then the Thrift Bank. The most kind of banks is the Thrift Bank. It encourages wise spending and savings. It offers loans with easy condition, low interest rates, and long-term payment schemes. And the Rural Bank, established with the mandate of Republic Act 720 or the Rural Banks Act. It has the responsibility to provide loans to farmers and fisher folks or small-scale entrepreneurs to better their lives and business in rural areas. These banks works in coordination with the Bangko Sentral ng Pilipinas. From an economic perspective, banks serve as a terminal for money to flow into the other sectors of the economy. The Bangko Sentral ng Pilipinas, together with the national government, analyzes the flow and distribution of this money. The Bangko Sentral ng Pilipinas also gathers data about the economic condition of the country. The Bangko Sentral ng Pilipinas is given the power to propose monetary policies to adjust to any economic conditions presented. Monetary policy is implemented by the Bangko Sentral ng Pilipinas to strengthen the economic state of the country. It is tasked to control the money circulating in the market to maintain the stability of production and prices. The BSP, together with the government, employs the monetary policy by changing the money supply. It includes coins, paper money, and checking deposits. By managing the money supply, the BSP aims to influence macroeconomic factors including inflation, the rate of consumption, economic growth, and overall liquidity. Also, the BSP may force up interest rates on borrowing to discourage spending or force down interest rates to inspire more borrowing and spending. Monetary policies are formulated based on inputs from a variety of sources. The BSP may look at macroeconomic numbers such as GDP, inflation, industry, and sector-specific growth rates and associated figures. Geopolitically, developments are monitored. Oil embargoes or the imposition or lifting of trade tariffs are examples of actions that can have a far-reaching impact. The BSP may also consider concerns raised by groups representing specific industries and businesses, survey results from private organizations, and inputs from other government agencies. Economists, analysts, and investors eagerly await monetary policy decisions and even the minutes of the meetings in which they are discussed. This is news that has a long-lasting impact on the overall economy as well as on specific industry sectors and markets. There are two kinds of monetary policies that the government implements. Easy monetary policy is also known as expansionary monetary policy. Is employed when the economy is down. In times of recession and depression, the supply of money is increased. Increased money supply in the market aims to boost investment and consumer spending. Investment growth and increased consumption will generate income. As part of easy monetary policy, the interest rates are lowered to promote spending money and make saving unattractive. Lower interest rates mean that businesses and individuals can get loans on favorable terms. The borrowed money will lead to consumption or investment. However, the BSP and the government must be on guard when increasing the money supply to avoid inflation. Inflation? How? When demand is high because of easy access to money, then it affects the supply of goods and services. Scarcity of resources and easy access to money creates inflation. To avoid inflation from happening, the BSP and government will work hand in hand in implementing the tight monetary policy. The tight monetary policy is also known as contractionary monetary policy. It is implemented while the economy is doing well or when inflation is about to happen. The government decreased the money supply to curb too much demand. This happens when production is unable to catch up with the increase in demand that results in a price increase. Inflation can be avoided if the central bank will lessen the money in circulation. The decreasing money supply is done by increasing interest rates. The increase in interest rates will discourage people and businesses from borrowing money. Less borrowing will lead to less investment. Less investment will lead to less income. Less income will lead to less consumption. And less consumption will force businesses to produce less or drop the price so they can attract consumers to buy. Price drop sometimes affects the quality of goods and services. And this is why tight monetary policy is not attractive to central banks, government, businesses, and consumers. The government should also be on guard when implementing tight monetary policy to avoid the onset of a recession or depression. Tight monetary policy can slow economic growth and even increase unemployment, but is often seen as necessary to cool down the economy and keep prices in check. The act of increasing and decreasing the money supply is to strengthen the condition of the economy. Through easy and tight monetary policy, the central banks can balance the economy. A healthy dose of interest rates and avoidance of extremely high and low prices can help stimulate the economy. People behave according to the economic conditions it is presented. The government and the central banks have a crucial role in influencing societal behavior. Thus, national leaders and citizens must have a wide understanding of how money works in the economy. I hope that this discussion will help you understand economics more. Until we meet again, as we unlock the mysteries of our society.